Welcome to the Startup Grind.
So we're really excited to have Scott here. Thank you so much for flying out and speaking with us tonight.
Thank you for having me.
Okay, so I would love to start with your background. So talk to us about where you came from and what led up to you now being the COO of Andreessen.
Okay, good. So since I was already 10 minutes late, I'm going to do this one very quickly. So I think I've been very lucky, and I basically had a series of jobs that I was never qualified to do, but managed to build relationships along the way that kind of convinced people to give me a shot to try things. So my background is actually, I'm a lawyer by training, believe it or not, although I am a reformed lawyer, so I've since recognized the errors in my ways there. No offense to any lawyers in the audience. And then had a chance in the last bubble in 99, 2000 to be an investment banker, so I was kind of one of the guys who was responsible for things like pets.com and all the wonderful things that we have left from that bubble time period. And then I just randomly got introduced to this guy named Mark Andreessen from a friend of mine who said, hey, you have to meet this guy. He invented the browser. It might be worth talking to. And I ended up joining what was then a company called LoudCloud a couple months after it started. And we were basically trying to build what is now Amazon Web Services, but at least 10 years too early. So it's a great example of obviously timing does matter in this business a lot. We did a bunch of gyrations and ultimately managed to sell the business to Hewlett-Packard in 2007. And then just because of the relationship I'd had with Mark Andreessen and Ben Horowitz, who was the CEO of that company, just got, quite frankly, the lucky opportunity to join the firm when we first started. So it was no more than just being in the right place at the right time and meeting people and getting a chance to do stuff that probably I shouldn't be doing. So.
And you took a pit stop in the middle of that to work at HP.
That's right. I was at HP for a little under 2 years. So we sold our company, which was then called Opsware instead of LoudCloud, to HP, and did a stint there running the support and the SaaS business inside of the HP software division. So that was a fun detour.
So out of curiosity, how many of you here have currently or have in the past worked at HP? How many HPers?
All right.
Nice. That's a great representation. Jeez, that's awesome.
That's great.
Okay, so Andreessen Horowitz is known for kind of breaking the mold when it comes to your style and your structure for venture capital. Will you share with us briefly what your structure is?
Yeah, so we are a little bit different, and the basic idea behind the firm is how can we back kind of product technical-based founders and then hopefully enable them to become long-term CEOs. So we have a bias towards people who've got either product backgrounds or technical backgrounds, and we don't have a bias towards prior CEO operating experience. And so everything we've done at the firm with that kind of goal is to figure out how can we enable that. And so there were really two things that we tried to do. One is make sure that all the partners come from operating backgrounds so that they can actually be effective board members and kind of help this person become the CEO by scaling and growing and coaching them. And then secondly, which is probably more significant, is we have a very big investment in basically services to help our entrepreneurs grow their company more effectively. So we've got a little over 100 employees today in the firm, and about 2/3 of them are on this kind of post-investment services side. And it's everything from helping them with sales and marketing to PR to corporate development, so raising capital, selling their companies if necessary, dealing with the press, and anything that basically you might not know being a first-time CEO, but that you will need to know in order to build a successful company.
That's great. So every VC has hits and misses.
Yes.
Will you share with us some hits or misses?
Sure. Well, we've had, the hits are easier because we've only had a few of those so far. There's probably a lot of misses that we just don't know about, quite frankly. So the hits that we've had, which have been great so far, one that you may know about fairly recently, we were an investor in Oculus. That Facebook bought, and that was an incredible hit in that in a very short period of time, literally like 4 months after we invested, Facebook ultimately bought the company for several $1 billion. Not really, I'd like to say that we were smart about that. I think that was mostly lucky, but sometimes it's better to be lucky in this business than otherwise. We were part of the group that bought Skype out of eBay, and that was also a very successful win for us. And we had a company called Nicira, which is in the networking space, that was basically building kind of a software-defined networking company that was bought by VMware for about $1.25 billion. Very traditional kind of venture investment that turned out very well for us. So we've had a few nice hits. And I think the biggest lesson we've learned in all these is we spend a lot of time debating the idea. And in many cases, particularly at the early stage, it's not worth spending that much time on the idea because what actually gets built is probably going to bear little resemblance to what that idea is. And so as we think about kind of what we're investing in, we try to spend a lot more time thinking about this team and what is it about this team that makes them uniquely qualified relative to others. And let's assume that the market's going to change. Let's assume the product's going to change. Let's assume everything's going to change. Is this the team that can actually maneuver their way around those changes and ultimately build a big business?
So you really are looking closely at the team.
Absolutely. It's by far the most important thing. Now, obviously, look, at different stages of investing, of course, you have other things to look at, right? So if you're coming in at a Series C or a Series D round, and there's actually metrics to look at and numbers and stuff. Of course, those things matter a lot at that point in time. But most of what we do, about 75% of our investments are kind of Series A or Series B, where there might be a little bit of data to look at, but for the most part, you're really talking about evaluating the kind of fitness of that team to go after the opportunity they're trying to build.
That's awesome. So I also heard that you guys go to about 20 universities a year and looking at students. So tell us what you're looking for when you go.
Yeah, so when I mentioned that we've got kind of 2/3 of our headcount that sits on this post-investment services side, one of those services is what we call technical talent. And the basic idea is how can we use our brand and our reach to help augment the talent pipeline for our companies so that they can hopefully grow their businesses faster, get access to engineers, get access to product managers. So think about all the individual contributor technical roles that a company has to fill. And so part of that organization is calling into existing engineers who are in the job market already. But then the other half of that organization, about half the team, is focused on the college campus setting. So we'll go, actually it's about 25 universities now, we'll go basically on campus, host an event at the computer science department, all with the purpose of allowing our companies to basically get access to that talent pool. And from our perspective, we're treating it like a portfolio, right? So it doesn't matter to me at the end of the day if that person goes to Pinterest or Airbnb or to one of our enterprise companies. What we want is to build a relationship with that engineer and be able to track that engineer over the course of their entire career, so that every time they think about picking their head up and are thinking about changing their jobs, we would love to be the first call where they say, hey, you guys must have something interesting for me that I should be exploring now. And so our whole goal is to build long-term relationships with the talent in a way that can hopefully augment the recruiting efforts for our companies.
It's working though, because my husband and his friends have a circle and they go to you guys for recruiting and looking for jobs, and it's fabulous.
Yeah, it's when you think about when you bubble up what we're trying to do at the very highest level, the asset that we're trying to build as a venture capital firm is a network, right? And it happens to be the product, of course, that we produce is investing in particular companies. But our view is the long-term competitive advantage that we hope we can bring is if we are, kind of the most important kind of player in the network of all the most important people and companies and entrepreneurs and everybody who's involved in the ecosystem, then we ought to be able to ultimately help our companies grow more effectively, and that'll ultimately generate better returns for our investors. And that's how hopefully the virtuous cycle works.
I think it's working great. It's amazing. So my question, I read this white paper on old power and new power and things that are happening, and I think it's very much indicative of what we're facing in every one of our ecosystems, not just in Silicon Valley. And so you have this old power of almost like a currency from the top down, and you guys came in from a network approach and having nodes and networking like you were talking about, building this network. And I think it's something that we also have here in Boise and in a lot of communities outside of the Valley. So will you talk to us for a little bit about that?
Yeah, it's funny. So I'm not sure if we're old power or new power.
You're the new power. They're the new power. They're shaking things up.
I'd like to think we're the new power, although my partner Mark Andreessen often says that we may be the most evolved dinosaur. And so the reality is, the real irony of all this is, despite investing in the most innovative businesses in the world, the venture capital business as an industry, quite frankly, hasn't evolved in the last 45 years. So the makeup of the firms, the way most of these firms are put together and operate, is very consistent with how they did 40 years ago. And look, it's worked very well for them. So I think it's only in the case where you have new entrants potentially coming in and saying, hey, maybe there's a different approach to doing this that it's worth. So I don't know whether our model is the right model, to be completely honest. We're doing something different. Time will tell, whether it actually does produce better outcomes. At the end of the day, as I always tell our investors, or actually I should say they always tell us, it's very easy to see whether you're doing well or not in this business. You either make money for us at the level that we want you to make, and we'll give you the money and let you play it again, or you don't, then the game's over, and it takes a while, unfortunately, in this business to figure it out. So we think we're onto something here, but it's incredibly early, and the biggest threat that we and everybody else in this industry has is some other new firm comes along with a different approach that could very well upend us as well. So we've got to always be mindful of that.
I don't think people realize how competitive the VC industry is. Will you share with us some insights there? Yeah,
what's interesting is it's incredibly competitive, and it's gotten more so, at least in Silicon Valley, which is the area where we spend most of our time, over the last probably 8 to 10 years. And if you think about it kind of before that time, the balance of power was really shifted, and the venture capitalists, quite frankly, really controlled things. And in some respects, you were lucky to be able to get introduced to a venture capitalist who could then kind of evaluate your opportunity. it was definitely a black box from an entrepreneur's perspective. If you think about it, if you were an entrepreneur in Silicon Valley in 1998 or something, there weren't things like this. There weren't meetups. There weren't all kinds of kind of activities that brought the entrepreneurial community together. And Y Combinator may not have been the ultimate end-all be-all for that, but it certainly started a movement of kind of community in a way that just didn't exist before. And now, it's not all for good. Meetup in quite frankly, people are talking about, Series A anti-dilution provisions or something, which probably isn't the greatest, and most scintillating thing to be talking about. But it does show the level of kind of, the level of sophistication from a financial and investment perspective that's changed. So the way we think about it is, look, any deal that you know about, you have to assume that that entrepreneur is smart enough, and they are, to have talked to other venture capital firms about that deal. So the idea that you've sole sourced something and that no one else knows about, I think you're just kidding yourself. And anything that is perceived to be hot, whether it turns out to be hot or not, right, will have multiple, term sheets. The timeframes will be very, very short in terms of making decisions, and so it's intensely competitive. And I think, what we think about every day is how do we make sure that we're in front of all those opportunities, that we're kind of front and center with the entrepreneurs in a way where we don't wake up and read about a deal in TechCrunch the next morning that we, quite frankly, had no idea that was going on.
So if a company is coming to you, it's hard to get into Andreessen, to get in front and pitch to you guys, but especially if you're outside of the Valley. And so there's several people and several communities around the world that would love to have a place at your table and have a conversation, even if it's 10 minutes. But what do you look for? What advice do you have? If you are ready to be seen, what are you guys looking for?
Yeah, so the first thing I would say is we're hopefully not that hard to get in touch with. So it's a little bit of a test, I think, of your entrepreneurial willpower, which is you ought to be able to find a way to get in front of us. And I don't mean it's not that hard, right? So I think, you ought to think about, okay, who do I know in what places that can kind of make an introduction? And it's not the case that you can always go in blind, but I think the reality is most of this business is a referral business. And so you're always much better off if you can actually get your, business idea in front of somebody who has a connection. And I think the reason we think that way is it's very true as an entrepreneur that part of your success is going to be based upon your craftiness and your ability to kind of figure out what relationships you have and how can you navigate those relationships, whether that's trying to find customers or it's trying to find financing or it's trying to hire employees. So it is a little bit of a test of how serious are you about this opportunity that you ought to be able to find a way in. At the end of the day, there's no simple formula. I guess the only formula I can say is we assume that that most of the markets that people are going after are going to be big opportunities. Now, there's a lot of times you look at something and you say, I just don't think that's that big of a market, and that's a good reason not to do something. But kind of the table stakes are it's got to be a big market opportunity, which means, at least from our perspective, that we assume it's going to be an incredibly competitive market, and there's going to be lots of companies going after that market. So it really comes down to where we started, which is what is it about this team that makes them uniquely suited to go after this opportunity? We use the word secret all the time internally in our firm, which basically means, what is it that these people know that no one else knows, and how did they earn that secret? So was it some life event? Was it this has kind of been their life's mission? Did they go do a PhD in this area for the last 10 years? And so we can't conceive of, is there a better subject matter expert who could actually go after this business? And the reason that's so important is not only where we started, which is that the business ideas will morph over time, and so you're really investing in the team. But the way to think about it from a venture capitalist perspective is the opportunity cost of investing in entrepreneur A is infinite, because that basically means you've now conflicted yourself out of that category of companies. And kind of one of the worst cardinal sins I think you can make as a venture capitalist is you can get the category right. So you can be right that social networking in 2004 was very interesting, but you didn't pick Facebook, you picked somebody else. And there's lots of reasons why you might have done that. But you have to think about it in that context, which is the opportunity cost is so high, and therefore every decision you're making has got to be around the fitness and the ability of that team to be able to actually accomplish what they're trying to accomplish.
Thank you. I think that's fantastic. It's a great insight. And as we spent today going through the day and learning a little bit about Boise and BSU and investors and kind of the state of where we're at as a community, what advice, what have you seen? And talk to us a little bit about that.
Yeah, so first of all, it was a great day, and thank you for doing this. And I understand the weather is always like this in the middle of March, so
it's always
perfect.
Beautiful.
Look, the most amazing thing to me, and I admit I was just completely ignorant, just not having spent any time up here. I was fascinated. We spent the morning, as you mentioned, at Boise State. It was fascinating to me, kind of the level of understanding and the engagement that the university has as it relates to trying to foster entrepreneurship. So one of the big things we talked about was kind of, what things have made Silicon Valley work, and certainly the centrality role that Stanford played really in helping kind of develop the ecosystem. And we talked a lot about that, one of the risks that we would think about, or other venture capitalists would think about in terms of investing in some area outside Silicon Valley is the ability for that company to scale. And I don't mean ability in the sense of like, is it a good team, but the ability to actually go hire not just the 20th and 30th engineer, but the 100th and 200th engineer, or how do you get the right executives also to come into the company? And it was really incredibly refreshing, and I think, very, very kind of inspiring in terms of confidence to see that, at least at Boise State, at the university level, they understand very clearly that this is kind of a top of funnel issue that they need to work on from and it doesn't obviously just start in the university side, it's got to go back into the K through 12 system, but kind of getting to critical mass in terms of kind of the number of engineers that they're producing on an annual basis, such that you can de-risk the company scaling process and therefore make this continually, continue to be a much more attractive place for additional investment. That was pretty amazing to me. And look, I don't see, usually when I go see universities, what they worry about is how can we lock down our IP tightly enough so that we don't have people stealing IP. And if you think about what Stanford did that was so incredible was they basically made it permissible for professors to essentially think about commercialization of technology and to go back and forth from academia into the business world. And so much of, I think, what has made Silicon Valley kind of a bit of a repeatable system in that respect is kind of that almost like marriage between academia and the commercial environment. And it sounds like at least, everyone here is at least thinking about it in that same context, which is pretty interesting.
Scott's Twitter is S. Cooper, so there you go, at S. Cooper, there you go. You guys have a lot of books there at Andreessen Horowitz. You guys are all big readers. And so I heard that when you walk into your office, you've got this whole row of books and this wall of books. So if you had a recommendation for us, what would you recommend?
It depends on what you like. I like reading generally biographies. The new book called The Innovators, which is, I'm blanking on the author's name, you probably remember. The guy who wrote the Steve Jobs book is quite an interesting book. A book that I found totally fascinating, which I never would have guessed, is a book called Frackers, which is literally all about kind of the oil revolution in the U.S. So Mark Andreessen is actually the kind of ultimate reader in the organization. So anytime I'm about to get on a plane, I always send him a message for a recommendation, and he's encyclopedic on this. So he comes back always with like 20 books. And so actually I was very excited because for the first time last week I was in Boston visiting one of our investors, and I learned about a new book, which name now will forget me, but it's about essentially it's about a Russian money manager, and kind of literally reads like a spy novel in terms of his all the various machinations he went through, kind of managing money. He was a hedge fund manager in Russia. But I was less excited about the book, and I was more excited about the fact when I sent it to Mark, he hadn't actually read it yet. So it's the first time ever that I've been able to give him a book recommendation. But I think to me, like I love reading the biographies just because I think you learn so much about it. It's just there are things that you realize that are directly applicable to your day-to-day business that you never would have thought of, and I just think kind of the diversity of experiences that you see people go through is, to me, what's most fascinating.
So on that line, do you have a hero?
No, what am I supposed to say? I don't really know. I don't have any heroes. I think I really don't actually, believe it or not. I think people, and part of it is a little bit of my own belief, which is I think people make their way in life, and people kind of are successful or not, oftentimes based upon who they surround themselves with and what their networks and their relationships are. And I certainly think, as someone who spent a ridiculous amount of money on education, we tend to overestimate the value of education and underestimate the value of building relationships and getting to know people. And so for me, a hero would almost imply that somebody on their own has actually kind of, accomplished everything that they accomplished without the help of teams and with networks and everything else like that. So I don't have a great answer for you, unfortunately, on that one, but I think that we continually undervalue kind of both circumstance and also kind of the people who you surround yourself with. And a lot, I look at myself, and a lot of why I'm sitting here today is just a function of kind of having met various people along the way and taken the time to kind of invest in those relationships, and ultimately, those things bear fruit over time.
I love the concept of building relationships and strengthening those. I think that's what we try to do here at Startup Grind, is really get you guys together to build friendships and connections, not just like networking. And so hopefully you guys take that from today, and you guys have made a new friend, a new network. Now, you're also teaching at Berkeley.
Yes.
So if we were to get the Cliff Notes, will you give us the Cliff Note version? You get a Berkeley education here.
I'm not sure there's a Cliff Note version. You have to actually read the cases, but no, I'm co-teaching a class on entrepreneurship, and in fairness, I would heavy emphasis on the word co-teaching, because the real instructor is actually doing most of the heavy lifting. But the basic class, which is very interesting, and it's probably not novel to Berkeley, I think it's true at most business schools, is taking people through the company building process. So everything from how do you think about kind of, what does lean startup mean, and how do you think about kind of product iteration, and how do you then go think about go to market, and kind of the project, of course, the class culminates in a project where, people have to kind of go build their own business plan and again present it, and we have VCs come in and kind of evaluate it from a funding perspective. So it's really just think of it as the life cycle of company creation, which for any of you who obviously have been through it, kind of is not a linear curve up and to the right. It's always kind of this incredible series of ups and downs, and that's part of what we try to convey in the class.
I'd love to take that class. Okay, so we always open up for Q&A. So we're going to take a second to come out to you guys in the audience, so think for a second.
So the question I have to you is, how do you measure your beta and alpha as a benchmark so your investors know you're in where you belong, both on risk and the alpha return?
Yeah. That's a very good question. So let me, for those of you who aren't familiar with this, right? So, think about beta, which is, and you can correct me if I get this wrong, but think about beta as how much do you move in lockstep with the overall market, right? So if the S&P goes up, do you go up generally as well, or are you kind of correlated or uncorrelated? Alpha, excuse me. Sorry, you've got it right. So I can't give you a precise answer from a quantitative perspective, but let me tell you how we think about it, which is, look, this is, we think why people invest in us is to be able to have, a return that's significantly different from the return they can get in the public markets, right? And I think, different people have different benchmarks, but in general, when I talk to our investors, you ought to be able to think that if the S&P is going to do 7% maybe for the next 10 years, we ought to be able to do at least 500, if not 800 basis points higher than that on a consistent basis over time. So, I think what that really works out to, that's kind of the minimum, I think, to kind of at least be in the discussion. I think in practice, when you look at venture capital firm returns over long periods of time, if you're not producing kind of net 20% IRRs over a consistent time period, I think it's very hard for people to justify the illiquidity of the asset class, as well as kind of the risk, because the reality is also that, look, there are time periods where, we will return zero. So, we will tie up people's money for 10 or 12 years, and ultimately, could end up in a scenario like we did in 99-2000, where, the returns were certainly fractions of what people put in from a capital perspective. So I think that's, at least, when I talk to our LPs, who tend to be mostly endowments and foundations and family offices, kind of net 20% returns from an IRR perspective is kind of, the minimum benchmark that they want to see over consistent periods of time. We're a larger fund, so we will probably, I think for us, we need to have consistency of those returns, and we will probably have less variance, in the sense that because we're a larger fund, we probably won't have, 20x kind of funds, just given the size of the dollars we're investing. And so I think the second piece that at least I hear a lot from our LPs is consistency of those returns over very long periods of time, which probably means 20 or 30 years. So that's at least how we think about it, and I think how people think about the asset class today.
Mark Cuban recently came out and said that he thinks there's a huge bubble happening. Do you agree, disagree, or why not?
Let me unpack that, because there's a lot of stuff implied. So what Mark Cuban, the main comment Mark was talking about was actually at the early stage, at the seed and angel market. And his basic comment was, look, it's crazy, valuations have run amok, there's way too much capital. And his overall conclusion was, this is a problem, and it's going to end with all of us, crying in our beer at the end of the day. So I agree with part of what he said. I actually disagree with his conclusion. So I do agree, at least where I come from, right in Silicon Valley, that there is a lot of capital that has come into the early stage seed market. In fact, if you look at what's happened in the venture business overall in the last 8 years, almost all of the new venture fund formation has happened in the sub $100 million, and probably almost all in the sub $50 million fund size, which is basically all seed and angel activity. And so there's no question in my mind that there's probably, that used to be just people writing individual checks out of their checkbooks, right? So that market has now become institutionalized. And I agree with his overall comment that there's probably more capital than is supportable with the number of companies that are being started. Where I differ with him from a conclusion perspective is, I actually think that's a fine and a good thing, And I don't think it's going to end with everybody in tears for a couple of reasons. Number one is what it means is the amount of experimentation that can happen with relatively small amounts of capital, because also the input costs, as we know, have all gone down on the technology side. To me, that is a tremendous opportunity for entrepreneurship, whether it's in Silicon Valley or whether in other places. And yes, the reality is the attrition rates are going to be very high, and a lot of those companies won't make it. But quite frankly, I think that's an okay and a fine thing. And I think that process of winnowing down from a large set of potential opportunities into a smaller set of winners is a good and a fine process. When you think about it in terms of dollars, all those dollars in the early stage seed market are less than 5% of the total venture capital dollars that get invested, which is also why I don't agree with him that I don't think this ends in tears at the end of the day. Because yes, it's possible that some significant portion of that 5% will be lost, but I think the benefit to the ecosystem of people knowing that they can actually go out and raise capital and start things will more than compensate for that. And so look, yes, if your whole job is you are investing as a seed investor, I think you have to be careful, at least in the Valley, and I don't pretend to speak for what the market here looks like, but I think it's actually quite a healthy thing. I'm going to skip it because in the interest of time, there's a whole other discussion about other parts of the ecosystem and whether, kind of valuations are high. But I think, at least with respect to his particular comments, at least that's my current view on it.
I take a little bit more 101, and can you talk just a little bit about the why and when people should be talking, not necessarily to Andreessen, but
Yeah.
VC and seed versus, super early stage?
I think the decision to take venture capital is not a light one, and I think, we all kind of assume that venture capital is the right funding for all startups, or at least anybody who sits in this room assumes that. And it's just not the case, right? So I think the most important thing to think about, the threshold question is, are you prepared basically to take on the responsibility that means? And I don't mean that, like we're really big, important VC guys and you have to worry about it. But what it does mean is now you have someone else who's part of your company who may or may not have the same view or vision for what you're trying to build. And you have to kind of be willing to kind of cross that chasm and say, okay, I'm willing to give up a little bit from a control perspective, I'm giving up a little bit from an economic perspective, but probably more importantly, are you aligned with the vision of what you want to build? And we were talking about this earlier today in one of the sessions. The biggest reason why we tend not to invest in a company is because we lack that alignment, and it often comes in the form of what you want to build, what's the ultimate outcome you're trying to get to. So what you have to remember, right, and I know you know this having been through it, but for our business to work, the way our business works basically is probably up to half of what we do, we're going to lose all of our money, or most of our money. And there's going to be 20 or 30% where we might make a little bit of money. And the only way our business model works at the end of the day is there's some small 10 or 15% portion of the dollars we invest that ultimately return 20, 50, 100 times our money, basically. And so every time we're making a bet on somebody from a venture perspective, we have to believe that it has a chance to be in that category, that it can be in that kind of uncapped upside category is how we think about it. And so you have to go into that VC discussion knowing that we are going to be sadly disappointed, even though it may be the right thing for the company, we're going to be sadly disappointed when you exit for $100 million and it's life-changing for you in terms of your family, and I get that. But it's not life-changing in terms of the business that we ultimately have, which is we have to give pensions a 20% return on their money. So to me, that's kind of the threshold question I think you have to be willing to ask. Whether it's A or seed or otherwise, to me, it's a question of what are the milestones, how much money do you need to achieve the milestones over a reasonable period of time to get to that next round of financing. So, strangely enough, every time we see an entrepreneur, we always ask them, what's the story you're going to tell at the next round of financing? So if you're raising an A right now, what's the B round story going to look like? And then let's work backwards from there and say, okay, look, if you need to be able to accomplish this, how long will that take you? How much money will you need to do that? And that to me is kind of that's the process for ultimately determining kind of what's the right profile of VCs to talk to and what's the right amount of money to raise. Does that make sense?
You guys are getting more and more into, and more venture capitalists are getting into the seed round of funding.
Yeah.
Could you share just a little bit, number one, once a round is completed and the terms are signed and done and the money's in the bank, share a funny, what did the entrepreneur do wrong, and also what an entrepreneur should really actually do, to do it right.
All right. I don't know if this is funny, so I won't try to be funny. But exactly right. Depends on who the victim is, right? But the biggest mistake that I think I see, and I'll go on my soapbox for a little bit, is a lot of misunderstanding around this concept of lean startup, and this is the big mistake that I think we see with companies, particularly around the seed side. And at least as the kind of fact pattern that we see it a lot is as follows: people raise some money. and then their basic goal is, okay, which is a noble cause, obviously, how can I make this money last longer, which is a very noble cause. But what has happened, at least in kind of some of the mythology around lean startup, is people have decided that lean is an objective. And I will at least tell you from our perspective, and we're not by all means kind of the end-all be-all in this, the objective is to win. The objective is to build a big business and win. And absolutely, I don't want you, burning dollar bills in the parking lot, but I want you as a CEO to be making the decisions that are going to most set you up to be able to win, because it goes back to the earlier question, right, which is if you took venture capital money, you implicitly, whether you knew it or not, you went along with the contract, which is we're now decided we're going to at least give it our shot to try and build a big, enduring, important business that ultimately, obviously, can have financial opportunity for lots of people. And I often see people making at the seed stage these kind of trade-offs where and they come in and they say, look, like we managed to make this money last for 3 years, which is, again, a very noble thing to do. But in the reality, what's happened is, in the meantime, lots of their other competitors have basically, raised money faster and have been able to actually achieve more from a business perspective. And it may not be fair, but the reality is, like, that's a more attractive business for us to fund. So I don't know that that's funny. It's only funny in that, sometimes it ends badly, which is you can be lean and ultimately fail in the real objective, which is to win the market. And I see this over and over again, and I get the whole lean startup thing. It makes total sense to me, and the idea of product iteration is a wonderful thing. But I think people have taken the concept too far and made lean an objective, and I think that kind of misses what the actual point of lean startup is.
So you've been in our community for a day. You've shared some good impressions. I'd like to hear your advice in terms of what can we do better? How can we improve as a community? Maybe what we're missing.
Yeah. Okay, so I will happily answer that. Let me caveat with, I've been here for a total of about 8 hours, so you all in this room know way better about this community than I do. So I'll give you my impressions. Number one, as I said, on the very positive side, I was incredibly impressed with kind of the kind of, I guess I would say, the common thinking and alliance between, kind of the academic institutions in the city, as well as kind of the rest of the, business leaders. The big challenge or opportunity, depending on how you see it, is making sure that you can kind of de-risk that scaling issue, which I think is partly an engineering talent issue. And again, don't misunderstand me. This is not about not having great engineers here. It's about not having enough great engineers here to be able to get to a business where you can support 500, 800 engineers as these businesses grow. And I think the good news is, at least as I talk to folks, I think people understand that. And it's a really interesting area. I think the benefits of this area from everything I've seen is, look, it's a tremendously beautiful place to live. It's obviously got incredibly attractive cost of living relative to the Bay Area, which quite frankly counts for a lot. And I think even more significantly than the cost of living, I think you have I would call it kind of loyalty or anti-attrition in a way that you just don't have in the Bay Area. So one of the beautiful things about being in the Bay Area is there's lots of engineers. One of the horrible things is those engineers are more than happy to go to new opportunities as they come up. And look, that's just, for better or worse, that's part of the culture. And so that's not, that's just part of what we live with. I think part of the attraction of a place like Boise is you can not only provide lower cost, but I think you can also, I think there's just a different kind of sense of loyalty and kind of discipline for how people think about kind of job opportunities. So I think there's no reason why any of those things can't be solved. But I think but to me that's the most fundamental thing that kind of, for this to be the next Silicon Valley 15, 20 years from now at that volume of scale, I think you have to believe that I think you have to believe that you can kind of solve the top of the funnel problem from a kind of broader engineering scale perspective.
Being a content company, I just want to know how you feel startups need to integrate content, especially with things like Kickstarter, and then how can content companies collaborate right, hit the right price point, just what you feel kind of is the future for that partnership.
Yeah, so I think I actually think content is going to be one of the next major areas of actual real investment on the internet. So if you think about what we've done today, there was kind of there was content in the form of kind of news and everything else, which is great, and then you really had kind of almost I would call it uncurated user-generated content, maybe is the polite way to say it, right? And I think that's great and that makes sense. I think what we're finding though now that the internet as an advertising medium is much more mainstream in the minds of kind of most Madison Avenue retailers and how people think about kind of reaching their audience. I think what you're going to see, and I'll admit we're conflicted here because we're an investor in a company called BuzzFeed, but I think you're going to see a much greater integration of news and content and advertising in a way that, and it's not going to be just user generated, it's going to be actually like professionally managed content in a way that's going to really draw advertising dollars and audience numbers in a way that we haven't seen before. So that's what I think is going to happen. I think today content, I don't want to say it's gotten a bad name, but I think in general, people haven't invested, content has been an area people have invested a lot. I think that's going to change because I think the utility now that people see for reaching audiences on the internet is just at a different place. And so it's going to demand different forms of kind of more integrated content to actually make that achievable. So I think you're in a good spot.
Thank you. So last thing before we end, last advice for any of the entrepreneurs. How many of you guys are entrepreneurs, are doing your own thing or thinking about your own thing? Awesome, awesome. So any last advice for these guys?
Well, look, I don't have any advice because if you're an entrepreneur, you're actually doing the hard work, and we get to just sit here and criticize companies. Look, I think the only advice I would give you, which I know you all know anyways, is you have to be doing this for the right reasons. And I think the beauty of entrepreneurship and the beauty of what's happened over the last 10 years is we've kind of glorified entrepreneurship, which is a wonderful thing. But I think to the point where people forget and realize that building businesses is just hard, right? And we all can tell the story from after the fact of kind of how we went up and to the right, but nobody actually likes to tell the story of all the kind of zigzags it took to get there. And so I would just say, number one, just recognize that, my boss always tells me this, which is, for our whole lives, for most of our lives, we go to school, right? And how we're judged and how we're evaluated in school is based upon whether we get good grades or not, right? It's a very easy objective measure, and it actually, is a relatively easy way for the schools to do it. The reality is, though, in entrepreneurship, if you get a C or a D, that's actually a wonderful grade. Right, getting A+ is probably not realistic and not likely to happen. And I think, trying to get an A+ and slowing yourself down in order to try and get an A+ is probably a worse outcome than actually making mistakes along the way and kind of, being quick in terms of your path to iterate against those mistakes. So just, remember that, a good day means you probably are effectively getting, what would have otherwise been a failing grade in a different environment, but that's not how people get evaluated ultimately. These businesses are hard. They actually involve people, which makes them hard. And so just, don't let the narrative fallacy confuse you of all the successful stories you read about, because the reality is that's not how most people get there.
Thank you so much for joining us today. Thank you all.